Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Thursday, February 20th, 5:23 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Roundup daily market insight video. Market state, we're in an uptrend. Check the trend gauge over here, though we've had some deterioration. Yellow sub arrow for leaders after two strong days of not just underperformance, but really some harsh sell-offs. Granted, a lot of these names were extended, but you'd like to see things that are extended pull back in an orderly fashion, and there's been a lot of dumping of some of these names over the last 2 days. Let's go to the major indexes, which we track across three time frames: the short-term 21-day, medium-term 50-day, and long-term 200-day moving average. Deterioration also small and mid caps, almost looking like a short setup if they would rally back in and fail again into the 21 and 50-day moving averages. We'll take a look at that when we get to the chart section, but deterioration there also. Big cap indexes continue to look okay. All indexes are still above the long-term 200-day moving average, which, as we say repeatedly here, the market never gets into serious trouble unless the 200-day moving average starts getting pierced on the indexes. So what happened today? Week open and sold off right away. A gap down about 0.2% on the S&P and immediately sold off hard for the next 30 minutes, but put in a bottom shortly after 10 o'clock Eastern time, then an attempted H pattern, which did not break down. And then that set the tone for a base the rest of the day and some afternoon strength that made these numbers look a lot better than they were early in the day. Let's talk about those numbers. I said leaders were weak, very obvious from our 21 over 21 list, with 20 of them down. The average one down 2.99%, very much not a good day for our 21-21 list. And that carried over to leading stocks and certainly to mid cap stocks, which is really kind of the hunting ground for the type of growth leaders that we like to look for. The big eight down 0.66%. The RG8, all of them negative, down 1.71%. So all the confirmation that we needed in that number right there. S&P 500 was down as much as 1%. Paired that to being down 0.4 by the close. We'll take a look at the rest of the indexes. The Dow the worst because of Walmart gapping down on weak guidance. Global 60/40 just barely negative. Our flagship GROTECTION portfolio down at 1.07%, underperforming for the second straight day, as some of the leaders that we're in, we got either got stopped out or trimmed or are pulling back, not as I said, not as peacefully as we'd like to, but for the most part holding the 21-day moving average. So let's get into the charts. Turn off stochastics here, turn off the list to get a better view. So the S&P 500, you can see undercutting the 8-day moving average, but getting back above it by the close. We'll go to the 60-minute chart. We've been talking about this consolidation that we've been in, that we broke out of yesterday, but back inside it today. And really, you want to, if you're a bull, you want to see another run at that 6150-ish level for a move up to all-time highs. We're going to have to get some participation from the NASDAQ 100 and some broad strength from some of these other names to make that happen. But that looks just fine. But it is a failed breakout to new all-time highs for now and back into the base. What we don't want to see, obviously, is what we saw on these prior three attempts at all-time highs, which was a move up, fail back to the low of the range, move up, fail back to the low of the range, move up, fail back to the low of the range, move up, finally a breakout, But it's frequent to test the pivot of the breakout, but you don't want to see it drop hard like this and rally back up on lighter volume into it and fail. So bears would want to see a move down and a break of today's lows. We would get more defensive if we see that, because that would be below the 6,100 level and down around the 21-day moving average on the S&P 500. We'll go back to the daily chart here, and you can see there's the 21, the 50-day now above the 6,000 level. Looking fine, but for now, a failed breakout to the upside. That's if you're a pessimist. An optimist would say, yeah, well, we undercut, reclaimed the eight, finished off the lows. Let's see what happens when we challenge this 6130-ish level again tomorrow. NASDAQ 100 again poked its head above the all-time highs yesterday, undercut and reclaimed the eight. This has been showing relative strength for 3 weeks, flagging a little bit now there. Let's go to the 60-minute chart. Looks a lot like the S&P chart, but the undercut of the high of the range and back into the top of the range shows that this has been the leader and continues to be. And obviously, again, today's lows crucial. Otherwise, we're falling back into this base again. That's the NASDAQ 100. Let's go to the equal weight S&P. And this looks fine, forming a cup and handle. Relative weakness, certainly from when it peaked back here in late November. You can see how weak the RSP equal weight has been against the market cap weighted S&P, not anywhere near the all-time highs on this leg up as the market cap weighted does. And that's just typical behavior when the NASDAQ 100 starts to outperform. Last of the big cap indexes, Dow Jones Industrial Average continues to flounder on a relative basis, closed below the 21-day moving average today, held the 44,000 level. Now, here's where the problems start. Mid caps, we've been tracking this very closely, multiple attempts to get above the 50 and the 21. We had that on Tuesday. It was short lived, back below both levels on Wednesday, and a much harsher break below that 3,200 level on Thursday. Now, with the 21 and the 50 rolled over, a failed move above then, a break of these today actually was a pretty low risk short setup. Let's go to the Russell 2000. We'll see something similar here. Declining 50-day moving average above it on Tuesday, undercut and reclaimed. It actually closed right on it on Wednesday, but failed, and the 21 is now rolling over today. A short setup would be a move back up into there and another fail into the declining 50-day moving average. Bulls really don't want to see that. You want to see all the indexes pulling in the same direction, but we don't always get what we want. So those are the major indexes. Let's go to secondary indicators and inter-asset correlation. The VIX, this is what we want with a 15 handle. No problem there. And the average true range on the S&P 500 on a 21-day basis is below 1 now. That confirms what we're seeing on the VIX, lower volatility, and we're fine with that. However, if you traffic in growth leaders the way we do, it's been anything but non-volatile over the last couple of days. But that's part of that comes with the territory when you're going to be in growth leaders. And Ted stressed in yesterday's video, and I want to reiterate again today, this is why we keep that core foundation in the S&P 500, because when these brutal rotations take place, if you're all loaded up in growth names, you're going to get hit hard. If you split the portfolio the way we do, basically in half, using leveraged ETFs and even ETFs, to get your beta and stay in sync with the S&P 500, and then add a little spice with growth stocks when they're working. That's our formula here at Revere. It smooths your equity curve. and lets you breathe a little bit easier on days like yesterday and today. I've had some people tell me, well, that's not sexy trading the indexes. I want to be in the growth names, and that's fine if you're the type of person that loves getting hit in the back of the head with a two by four about 15 times a year when the market decides to sell them all off. Uh, the average investor is not built for that, especially if you're just starting out with it. If you're starting out investing, learning these growth names, I recommend when you make a growth buy, you buy an equal, split it in half, buy an equal portion of the S&P 500 that you are to the same amount that you're putting in the growth leader, and watch how the two of them perform. This is why we write down where the S&P 500 was trading at every time we make a growth buy. We don't want to buy anything that's not going to be outperforming the S&P by two times, and it should become clear pretty quickly if they're not going to. So we kind of put a time stop on them the same way that we do with price stops. You want to see progress. Otherwise, you're just floundering. So that's the VIX. Let's go to the dollar. I'm fighting a bit of a cold here. Continued weakness in the dollar. Generally good for stocks, not good for growth leaders today, however, but this is what we want to see. Let and The inverse correlation continues. Dollar dropping, gold continuing to make all-time highs. GDX, we're playing this with the two times with Nugget, a nice move up today. Bitcoin had been languishing for a bit, making another run at the 21 and 50-day moving averages. It's failed there over the last 2 weeks, trying to get above it. So we're keeping an eye on that. You can see I've got an alert set above the 50-day moving average. Now, bonds, the broad bond index, bonds were up today. There's the broad, there's the TLT. That means yields down slightly. We want to continue to see these yields. The trend is down. They had a spike last week on tariff talk, but I've given most of that up. There's the long bond and the 10-year, the TNX, also down on the day. So that's our inter-asset correlation. Let's get to the tail of the tape, some deterioration in the stochastics on the indexes, but all in all, not bad. An updated sentiment numbers came out. Bulls continue to be lower than bears, which is very good from a contrarian standpoint. The NAIM, however, this is investment managers up to 91.5% invested, a jump of 16 points. Over 100 is kind of like waving a red flag in front of a bull. It's not good because that means they're fully invested. They've got no money left to put into the market, and that typically marks short-term tops. I mentioned the Walmart news that hit the Dow. Keys coming into today, S&P against the 6,100 level. Well, we undercut and reclaimed it, so that's a win from that standpoint. NASDAQ against the all-time highs, faded yesterday and today. But I've got the down arrow, but in yellow as not that really that big a deal. On the other hand, the Russell against the 21 and the 50 failed. And like I mentioned, the short setup there. Day count from up to with one consolidation. Eighth day above the 8-day moving average with the undercut and reclaim. 12th day above the 21-day moving average. From a sector standpoint, strength in stocks and some defensive sectors, energy, healthcare, real estate, utilities flat. So these are more on the defensive side. So another big cap rotation into them. To the downside, banks and software hit hard, and retail on the back of that Walmart's report. As far as the portfolio goes, stopped on snow, stopped on CFLT, and we trimmed our hood position. This is one where we did that 60-minute stochastic crossover buy, and it failed right away. No problem, just trim it for a small loss. We used it on Nugget a couple of days ago, and that's an example of it working. Hood, an example of it not working. So our adjusted beta 1.37, balance at risk 4.51% to the downside. Bottom line on the day, day two of growth leader weakness as small and mid caps break below their 21 and 50-day moving averages. Four keys for tomorrow. Again, the S&P against 6,100, NASDAQ against its all-time high, Russell 2000, these declining 21 and 50-day moving averages. Can it right itself and get back above it? If not, is it a short setup? And will leaders find some buyers after 2 days of sell off? These are the things we'll be keeping our eye on tomorrow. Let's get to some notable action in the 21 over 21. First of all, with Axon, the downgrade, and apparently they had a falling out with a partner. Two harsh days of sell off, huge failed breakout, breaking the 50-day midweek harsh break of the 50-day. We take it off the list. We replaced it with Spotify, which is going nicely sideways since its earnings gap up. Nicely sideways, however, is fine, but we're seeing a lot of no progress on some of these recent gaps up, including some that we've been in. We've been stopped on a couple of them. Let me talk about snow getting stopped out today. This was about a 3+ week hold, and it's just been choppy. No further progress to the upside. Break of the 21 today early. It did reclaim it by the end of the day. But with the weakness in leaders, sometimes you just got to sell it out. That's what we did. No progress. For very small loss on this, like 0.05% of the total portfolio on a 3% position. Really no big deal. But with earnings next week, did not look like we were going to have a reason to hold it. No cushion, no hold. And so we stopped out of that, also out of CFLT. This one's a big disappointment. I had a lot of high hopes for this with the big volume and the big bar that day breaking out of a big base, but sellers came in. They don't all work. When they don't work, it's best to cut for a small loss and move on. So let's go through the rest of the portfolio. Docs, uh, just going sideways since its earnings gap up and day two higher high. Now, this is very typical of what we've seen over the last couple of weeks. Some strong intermittent action by leaders was undone over the last 2 days. The best of them are still holding their 8-day moving average. The above average ones are still holding the 21-day moving average, and a few of them have broken the 21-day moving average. We'll blast through these. There's Docs, Bros, still very clearly a leader, sideways after its earnings gap up. Palantir, so the CEO said he's going to sell a bunch of stock going into September. That and the proposed 8% annual budget cuts for the Pentagon brought some big volatility into this. Uh, when we broke the 8 yesterday, we sold a piece of it, locked in the 20% gain. The rest of it we've held from lower and let it breathe a little bit. It did recover by the end of the day. So an undercut of the 21-day moving average there. We want to see it hold the 21 again going forward. Robinhood early on strength. I added to this. Let's show this 60-minute stochastic cross up for why I added to this. It was actually using the 30-minute on this one. So 30-minute was hooking up. If you go to the 5-minute chart on this, growth leaders were weak early, but this was showing strength. Early in the day, we added a piece to it. So this was one. What did it do? It had a nice run up going into its earnings. It gapped up on earnings, inside day on the second day, nice volume patterns, reversed, undercut the low of the gap up day, and then reclaimed it early in the day when I bought it. But what did it do today? Well, first of all, it floundered throughout the rest of the day yesterday. Today, it broke the 8-day moving average. It bounced at the 21. So the shares that we own from down here, we're still holding those from the 21, but the break of the 8 right away. on the failed, in this case, 30-minute stochastic cross. Um, there's the 60-minute was here. You can see it slightly hooking up as well. I with the 30-minute cross up, and I anticipated the 60. It didn't come to fruition, but tiny loss for the portfolio. As I said, still holding those other ones. Compare that to Nugget. This is one that did work perfectly with the 60-minute stochastic. So undercut into oversold on a pullback on the daily chart. 60-minute stoch crossed, that coincided with the 8 day being undercut and reclaimed. So we added some of our position. This has been riding the 8 higher. It got extended. We took some profits with it being extended about a week and a half ago, bought it back, and then a little bit more on the strength yesterday, following through to the upside today. So when you do the stochastic cross, basically we're looking at the 8 day moving average, and the stop would be below that recent low under the 8 day moving average. So very minimal risk we're putting on when we add to these types of names. Let's go with the rest of what we hold. Here's a firm undercut of the 8 day moving average, back testing the pivot, which it broke out of on its earnings gap. Upstart, another one trying to break out of a cup reversal, closed just below the 8 day moving average. This one's hanging on by a thread relative to our stop. EQT tried to break out yesterday on its earnings report, undercut and reclaimed the 21 today. We'll go through the rest of these. Here's Snow, where we got stopped, although it did reclaim the 21 by the end of the day. Cyber, nice bounce off the 21. AEM, uh, one of the leading gold stocks. Dash, undercut the 8, bounced at the 200 level. App Lovin, very volatile, undercut the low of the gap up day, closed right on the 8 day moving average. Howmet, after earnings and an earnings shakeout here, and then a breakout, and then it got an upgrade. This is looking pretty well, definitely showing relative strength. TKO, some volatility recently, closed right on the 21 day moving average. Interactive Broker bounced at the 21 today. SE undercut and closed right on the 8. Team, here's some weakness. It's right on the 21. HIMS, very volatile. Inside day today. Confluent, we got stopped on the rest of this with multiple failures of the breakout on earnings. The 8 day moving average did bounce at the 21, but at that point, our stop had been hit. And I said we added Spotify, undercut and reclaim of the 8 day moving average today. And that's a trip through the 21 over 21. As always, like to hear from you. The email's Don at revereasset.com. The phone's 855 Real Wealth. That's 855 732 5932. Our flagship portfolio is named GROTECTION. It is designed to grow assets during uptrends. We pull back, tap the brakes a little bit when things start to waver, get below the 50-day moving average. We get our beta down to about a 1. We would want the 20-week moving average to hold. You see it all the time, undercuts and holds of the 20-week. We break the 20-week, then we start getting into trouble down to the 200-day moving average. This is where all bear markets occur. We generally give the indexes the benefit of the doubt in stocks that are acting well as long as we're above this level. Below this level, big giant red flag, as all bear markets occur below this level. And when the wind is at our back, we like to accentuate our broad index position with leading stocks and leading sectors. Worked great last week. Things got a little bit of extended and pulled back hard over the past couple of days, but I just ran through them. You saw a little bit of damage in some of them, but for the most part, bouncing at or undercutting and reclaiming the 21-day moving average. If you like that common sense approach, give us a shout here at Revere. And with that, I'll wrap it for Thursday, February 20th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.